Hey brokers, how are you guys doing today? My name is Jeremy Millar. I'm super excited to be with you guys today and talking through a really exciting topic on a really exciting day. Today is tax day, so I hope you all are celebrating big time. Super exciting to talk about bookkeeping today and how bookkeeping is going to help to unlock your brokerage's growth, how great accounting can really help fuel excellence in your brokerage, whether it's excellence in hiring and planning for the future or just sustaining where you're at today. I'm super excited to go through all of that with you guys. A couple things to expect from me today. What we're going to talk about, I'm going to keep things super easy to understand, super basic, so that everything is super clear and concise. We're going to learn a couple of things about how accountants think about things and how we think about financials and how we think about businesses and accounting in general, so that you have the tools that you need to communicate to your bookkeeper, but then also so that you have the tools that you need to make effective decisions in running your business. So I'm going to bring up those slides here for me right there. Perfect. Fantastic. Well, welcome to Bookkeeping for Brokers. Again, we're gonna chat through how proper accounting is going to unleash your brokerage's growth. So my name is Jeremy Millar. Once again, I am with Marlo, and we are a bookkeeping and virtual CFO service for mortgage brokers. We've been working with brokers for several years now, probably about 5-6 years, and we just love the industry, love the type of business that brokerages have. We're an AIME vendor member, the kind of premier partner of for bookkeeping. I am not a tax guy, but once again, just happy tax day. It's a big holiday for us accountants, regardless of if we do tax or not. I am specifically a bookkeeper and a virtual CFO, and that's what we're going to be talking about today, which does have implications for tax. But we're going to learn how this bookkeeping service can really help to unlock potential in your brokerage. So let's dive on in. When we've been working with brokers in the last couple of years, there's something that I discovered, and it's that I met some brokers who were content with their business. They were super happy with where they were at. Maybe they'd been in the industry for 20, 30 years. They are fulfilled by the work they do. They are happy with the money that they're making, the time and the freedom that they have. And they feel good about where they're at. They feel good about their team and what their business is doing. And they feel confident that they can kind of weather any storm that the market might throw at them. Then I met other brokers, people who were confident in their plans for growth. They're trying to take over the world, become the premier, go-to brokerage in their area or in multiple areas. They have this vision for the future, and they're going to do really whatever it takes to make that vision come true, to make that vision a reality. And they're confident in their plan for growth. But many of the brokers that I talked to didn't fall into either of those categories. They were neither confident in their plans for growth and where they were headed in their business and feeling good about tackling any challenge that the market might throw to them. And they weren't satisfied with where they were at. They were neither confident nor satisfied. It's kind of in between and a little bit confused or flying by the seat of their pants to try to figure out how to weather the storms the market were throwing at them, how to grow, how to really just run their business in an effective and efficient way. Why is that? Why do we as brokers encounter that? Why are so many people encountering that issue? Well, I have an opinion, of course. I think that most brokers, it turns out, don't look at their finances, or they simply don't get them. Either they don't literally receive them from their bookkeeper or their accountant, or they just don't really understand what's going on. It's not laid out in a way that is useful for them. They're not really understanding the story behind what's happening in their financials. So what I believe is that unlocking your financial story, the narrative behind what's happening in your business, why things are the way that they are, why your business is behaving the way that it is. That's key to fueling growth or to sustaining success, one or the other, or both. It depends on what your brokerage is hoping to accomplish. So, in order to understand, first of all, how to get to this place of confidence, of contentment, satisfaction, and knowing that you're on the right track in your brokerage. In order to get there, I think that we need to unpack the story that is happening in your business that your financials are trying to tell you. And in order to do that, we have to do that through excellent accounting. And I know that sounds crazy. Some of your eyes just glazed over. Some of you groaned. We're talking about accounting. You're looking at a webinar about accounting, so you should have seen this coming. But accounting itself, I think, in order for us to understand exactly why it's helpful, exactly what purpose that it's going to serve, and exactly how it's going to serve that purpose, we need to understand what accounting is, what bookkeeping is, and how it actually works, just from a high-level perspective, in order to understand how it's going to affect our business when we do it correctly. So, what is accounting? Let's get on the same page here. Accounting is the interpretation and communication of financial information. So, accountants are people who look at financial information and help to interpret and communicate the story behind that information. They help to interpret and communicate what is happening from a financial perspective in a business. And bookkeeping, as kind of a subset of accounting, the thing that I do, my firm does, bookkeeping is the process of organizing all of that information, that financial information, and organizing it into its proper places so that we can understand, communicate, and interpret the story that's occurring in that financial information. So how does that work? How do we do that as accountants? What does that look like? It's kind of mysterious to a lot of people. Accounting is a different language. And in fact, Warren Buffett back, maybe 10, 15 years ago said on an interview with CNBC, he said, accounting is the language of finance, the language of business. Accounting is the language of business. Finance is the most important tool that we have to understand what's going on inside of a business. So if we want to understand what's going on inside of a business, we have to get really familiar with accounting, how it works, and what it means. So let's walk through that together using what I call affectionately the bucket theory. Accountants use 5 buckets, and this is going to make a ton of sense once we walk through the basics of how accounting works together. You'll see that accounting systems are meant to be set up in a certain way, and you'll be able to actually use this language, this way of thinking, to communicate with your accountant, with your bookkeeper, with your tax person, whatever it might be, in order to speak the same language. So accountants use 5 buckets. These buckets, they form the basis of every single accounting system. So no matter what company you're running, if it's a $10 billion company, if it's a multi-million dollar company, if it's a company that only does $200,000 or $100,000 a year, it doesn't matter. The accounting system, the very foundation of your accounting system, is always the same. So accountants' buckets are these 5 things: assets, liabilities, equity, income, and expenses. We're going to walk through exactly what that means, exactly what each of these things mean, the significance that they have to your business, and how we're going to use them in order to really understand what's going on inside of our business so that we can build some confidence, some clarity, and a good understanding of where we're headed as a business owner. You may be familiar with a couple of financial statements. A balance sheet, for example, a profit and loss, maybe a statement of cash flows, depending on your level of expertise. A balance sheet is effectively a financial statement that shows what your business has, what it owes, and what it's worth. So your balance sheet is going to be this tool I like to liken it to a bank statement. When we look at a bank statement, we see the balance of our bank account as of a certain date. Today is April 15th. If I look at my March 31st bank statement, I'm going to see the exact amount of money that I had in the bank, a snapshot in time of what my business had in the bank at that time. And a balance sheet is that snapshot all in one place. It contains what our business has, what it owes, and what it's worth. So it contains our assets, our liabilities, and our equity. Our assets are resources technically owned or controlled by a business or an entity. And so that means that an asset could be anything like real estate, it could be a bank account, it could be money that you know you are owed, so money that you're going to be paid, receivables in that sense. And then it also contains liabilities. So a liability is the future sacrifice of economic benefit, of monetary value that you are obligated to make. A liability is just money that we owe. It's a credit card, it could be a loan, it could be bills that we know that we have to pay. A liability is money that the business owes to someone else and is obligated to pay back. And then we have equity. And I know I'm talking to a room full of mortgage brokers here. We know all about equity. Equity is effectively ownership of assets that may have debts or liabilities or may be owned free and clear. But equity is actually just a calculation. It's the accounting equation. It's assets, what we own, minus liabilities, which is what we owe. And the net result of that is equity. It's the book value, the worth of the business on paper, so to speak. So anytime I have money in the bank, minus the credit cards and loans that I might have outstanding and any other liabilities, I have my equity left over. It is the amount of money retained or amount of value retained in the business before being distributed to shareholders or after distributions to shareholders. So that is what our balance sheet is. It's a tool that helps us to understand our assets, our liabilities, and our equity. And it looks something like this. At the very top, we have our assets, we have our bank accounts, we might have other current assets, things that the business owns. Then we have our liabilities. We have credit cards, we have loans, we have bills that we might need to pay. And then at the very bottom of our balance sheet, we have equity, which is the leftover after assets minus our liabilities. So a balance sheet helps us to understand how much cash a business has, what it owns, what the business owes to someone else, and how much is left over. And equity is super, super important. A balance sheet in itself is a super important tool to help us understand whether the business is in a good financial position from a cash perspective. Do we have enough money to satisfy all of our liabilities, to satisfy our net worth requirements that states might impose on mortgage brokers, to satisfy the ability to distribute profit to the owners? The balance sheet is the single most important tool in helping us to understand those facts. Now, a more commonly understood financial statement is the profit and loss. And a profit and loss is very, very easy to read, hopefully very easy to understand. It's what your business earns and what your business spends. It's your income and your expenses. Income, of course, being the amount of money that the business receives in exchange for goods or services. You are closing loans. You then get a wire and your commission comes back to the bank. That is income. You make money. Then we have expenses, and that, of course, is a cost that a business is incurring in running their operations. So we have things like your AIME dues. We have your software. If we have to get on Arrive, maybe we're doing Bonzo or Lead Pops, whatever it might be. The things that we're spending money on, those are our expenses. So when we read a profit and loss statement, we have income at the very, very top. And then at the below that income, we have our costs of goods sold. We have our other expenses. We'll talk a little bit more in depth about this in just one second. But looking at this profit and loss, it allows us to understand really key information. It's a tool that allows us to understand key information about what's happening in our business. We see the money that we're bringing in, the loans that we're closing, the commissions that we're generating, the commissions that we're paying out, the costs associated with doing business, things like credit reports, appraisals, reimbursements, et cetera, tolerance cures, whatever it might be. Then we have expenses below that, the costs of actually running the business, keeping the business open, keeping the lights on. These costs are extremely important in understanding how much money we need to operate the business day to day, month to month, year to year, et cetera. Now, we know the basics of accounting. We know that there are assets, liabilities, equity, income, and expenses, but how do all of these pieces work together? I'm going to give you a really quick basic crash course. Now that we understand our terms, we're all on the same page. We know sort of what these elements are going to be used for, sort of what we can expect from our accounting system, how things might get recorded. Accountants actually use what's called a double entry system. So when something happens in a business, it has to be recorded in two places in order to keep balance. We have income and expenses, again, on our profit and loss, and then we have assets, liabilities, and equity on our balance sheet. And these two things, these 5 buckets, balance each other out in such a way that allows accountants and business owners who understand what they're looking at to really get a grasp and hold on what's happening inside of their business. And I'll show you briefly the interaction between all of these buckets and how they are working together. So, for example, let's say that your loan officers are having a good month. They just closed 10 loans at an average of, we'll say, give a flat number, $7,000 per loan. When the wires hit, you see a deposit into your bank of $70,000 worth of income. And that is represented by your income increasing by $70,000. And because that income has increased, you have received money, you have received cash, your assets also increase. Your bank account balance increases. So because you've made money, your assets increase. When we record that you made money, therefore assets increase. You now have more money in the bank. Makes sense so far? When an expense is paid, let's say that we have to pay out our LOs, their cut for the loans that they've closed. We're going to see commission expense to account for the money that is then headed out the door via payroll, via checks, whatever it might be. We are recognizing expenses. Our expenses are recorded. They increase. We have more expenses now because we're paying out $60,000 in commission. And our assets are decreasing because of those expenses. We are paying money out in order to pay our loan officers. So our expenses are going up and our assets are reduced because we are experiencing an outflow of money. Last thing here, when debt is paid off, let's say that we've got some excess cash and we've decided to pay off a credit card that has been hanging around. That Amex got a little out of control. We booked a great conference in Hawaii and, went on a trip and did some great education, networking, seminars, etc. But now we have a credit card debt that we need to pay off. So what happens is when we pay off that credit card, we are lowering our assets. We're lowering our cash in the bank in order to reduce our liabilities, the money that we owe to someone else, because we're taking money that we owned, the money that we had in our assets, and we are giving it to the person that we're obligated to pay that liability. So we're giving that cash to someone else, lowering the balance of our assets and liabilities at the same time. Makes sense. So we are using both sides of the equation here in almost all cases, depending on what we're spending money on or how we're making money. And we're using all of that in order to record that information in the accounting system. Now, finally, let's take a quick look at an example of what a sample brokerage might look like. This is an example of a brokerage that uses a P&L to understand what's going on in their business. And this profit and loss, for example, it shows us our sales at the very top. We have some expenses there down below, a lot of different expense categories. And this P&L is pretty typical of the types of P&Ls that we're seeing when we're talking to brokers. When I work with brokers and I evaluate their accounting systems, I'll look at their profit and loss with them and talk about, what are we seeing here? How does this tool help us to tell the story of your business? And the reality is that a profit and loss like this doesn't really illustrate what's happening in our business. You see, a profit and loss is supposed to be an excellent tool to provide clarity, to be concise, to provide information that we need to make effective decisions. And this tool isn't really doing that. We have lots of different accounts, lots of different buckets going on here. We have, for example, computers and internet has lots of different sub accounts within there. It's very long. There's multiple pages here that we have to sift through. This information is not very effectively laid out. So what do we do about that? Or how should a profit and loss look? Well, our P&L, as we know, it can help us understand how much of our income that we're keeping. You see, our P&L shows how much money we're bringing in. At the very top of any profit and loss with a brokerage, the thing that I like to do is have two income accounts: loan officer commissions and direct sales. And the reason for that is that I like to see of course, the loan officers who are originating and the amount of money that they're generating directly on that profit and loss. So I can see at a glance, all right, my loan officers are making about $70,000 in a given month. Great. Then I like to also see direct sales, which I think of as the broker owner's origination. This is the money that the broker owner is responsible for bringing into the business. It's the loans that the broker owner is responsible for closing, has closed, the deals associated with that person. And I've split these two out so that I can see how much responsibility is on the broker owner versus on the team of loan officers. And from there, we can see the cost of goods sold that we have here. Unlike our other profit and loss, where we didn't really have any kind of cost of goods sold, the expenses are kind of just scattered around in various different places. We might have credit reports in one area. We might have, jumbled together with other kinds of fees. But here on this other P&L, on this sample that we have here, we see that our costs of goods sold are grouped together in a way that allows us to see clearly the input costs of closing our loans. We have commissions, we have credit reports, appraisals, tolerance cures, etc. And that gives us our total cost of goods sold. And the reason that we like to organize things in this way is that we can see the direct, the sales that our loan officers are doing, the commissions that they're generating, the commissions that the broker owner is generating, directly paired up with the input costs of closing those loans, which then gives us what we call the gross profit. And gross profit is just exactly that. It's our sales figure minus our direct input costs. And that gross profit tells me as a business owner how much money that I have left to run my business, which is an incredibly important number. That gross profit number tells me how much money I have left to keep the lights on. We can use that gross profit figure and our P&L as a tool to budget, to understand how much we need to stay afloat each month. When broken out, we can identify fluctuations month over month and then understand the average amount that the business is spending. We can look at our main categories, things like general and administrative expenses, our payroll, our facilities, our legal and professional fees, and our taxes. The 5 categories, main parent categories that every single business has no matter what: general administrative, payroll, facilities, legal, professional, and taxes. These 5 categories allow us to see at a high level how much money we're spending in each department of our business. It allows us to understand effectively how much money is going into the overhead, the costs of actually keeping the lights on, our marketing and our general administrative expenses, our wages for our LOAs and our callers, or our support staff, and our payroll expenses, our facilities, our rent, or the insurance that we might have to pay in facilities there, legal and professional fees, how much we might be paying for bookkeeping or compliance or legal. At a high level, if these things are grouped together, we can see them broken out in such a way that gives us clarity and helps us to understand exactly what's happening at a very high level, so that we can then make decisions about where we need to increase or decrease our spending. And we know, based on our gross profit, if we're bringing in X amount per month, we know that we have that then left over to pay for the rest of these expenses. So once again, our gross profit, that input costs, or our sales minus those input costs, leads to our gross profit, which is then left over to run the business, to keep the lights on, to pay for our marketing, our arrive, our lead pops, our CRM fees, whatever it might be. Allows us to understand how much money we need to keep in the business to run things day to day, how much we need to budget for to stay afloat every single month. And finally, when we marry all of this together, we understand how much money is coming in, the direct cost of that money coming in order to produce the income that we're seeing, and then the amount left over to run the business in terms of all of our other expenses. We have almost a complete picture. We have almost a fully useful tool in the form of a profit and loss that gives us 90% of the clarity that we need to run a business. We can look at our income and say, am I making enough? Am I setting sales goals high enough to understand how much money that I need to bring in order to sustain the business? Am I making enough calls, reaching out to enough realtors, making enough connections in order to sustain the business month to month based on how much production I am doing? But it doesn't get us all of the way there, because it doesn't help us to predict the future yet. It does help us to understand the averages that we're spending in the past, which can then be helpful in understanding how much we might spend in the future based on the averages. So it does get us to a little bit of a future forecast, budget, and goal, but it doesn't tell us how much money we're going to make in the future based on our sales volume. And so what we have to do is we have to gather additional data to project a broker's future income. We have to look at things like average loan compensation. We have to look at things like average units funded. We can then use those things to map out our average revenue. We can look at average loan compensation. Let's say it's $7,000. Our average units is let's say we close 5 loans a month. That means that we know that we're going to close at least $35,000 in terms of deals every single month. Knowing that average, knowing what makes that up, how we can use those statistics, that information, that data, that financial information that we have, allows us to then take those insights and project out into the future and understand what's going to happen to a level of accuracy that is incredibly useful for weathering economic downturns, for weathering staff changes, for weathering storms, or planning for the future in how we're going to hire and what we can expect from our team in terms of production. Understanding our production, our volume, our loan comp, average revenue, et cetera, allows us to paint that picture of what's happening inside the brokerage so that we know exactly what to expect in the future. And we can then use that information coupled with the actual historical data that we have to look at, based on history, what has happened, and to look forward into the future and to project based on averages of the past and based on averages of what production has been, what our expenses have been like, and understand into the future what we think is going to happen in the market. Using this, we can see in this example, I have 6 months of historical data that we've laid out here. You see our income at the very top, our input costs and our cost of goods sold, and then our expenses, the costs that go into actually running the business. We can use that information into moving into the future. As you'll see in the blue, we have that forecast going forward based on averages, based on history, what's going to happen into the future, based on the number of the unit volume that we're seeing, the amount of production that we're doing, the amount of units that we're closing. Are they FHA? Are they VAs? Are they conventional loans? What are they? How is the story being written in your financials today? And using that information, using that story as a tool, as a tool to predict the future, to help you understand where you've been, and to look forward, it helps to achieve something that I think gives more confidence, more clarity, and more insights into running a business, especially when we're experiencing environments that go from extreme refi heavy markets into purchase businesses, and the cycle that rates take. We can look at all of that data together and understand what's going to happen in the future based on the financial information that a brokerage has. So it's my belief, in summary, that tracking your finances by using excellent accounting can fuel your growth, can reduce your stress, and really can understanding your financial story helps to take your brokerage to the absolute next level. Reviewing your books, understanding that story, that is essential. It's an essential practice for any broker who wants to be successful, any broker who wants to be content with where they are or confident in their plans for where they're going to be. Truly, accounting is the language of business. It's the story that allows us to read what's happening in our business itself, to make future plans, to see where we're headed, and to get there with confidence. And that is what we do every single day. We help brokers account for their financial story. Thank you guys for spending some time with me, learning about how accountants work, how we think about these things, especially on tax day. What a fun thing to do. Once again, my name has been Jeremy Millar with Amarlo, AIME's bookkeeping partner here. Scan that QR code. You'll be taken to a couple of pages that are AIME specific. You can also visit our website at amarlo.co, amarlo.co. I'm also going to be in Sacramento at the AIME Unify event next week on the 22nd, talking about strategies for business growth. And so if you're in the Sacramento area, come and join us. Come shake my hand, meet me, tell me all about how your tax season went and how you're weathering this environment right now. I'd love to learn from you, and I'd love to hear your story. Once again, Jeremy with Amarlo, thank you guys again for spending some time with me, and I'll look forward to chatting.